2024 has been a fantastic year for the stock market so far. The S&P 500 has gone up by 10% year to date, Nasdaq also 10%, and they could have been higher if it wasn't for Tesla, which crashed by over 30% year to date and is now officially the worst performing stock in the S&P 500. Look at how they massacred my boy. But you may now be wondering, how long can this bull market last? Are we in a bubble? And more importantly, how should you invest now? And that's what we are going to look at in this video. But before I start, do join my 8,000 members Telegram chat group to discuss or ask any questions that you may have. Just a few days ago, the Fed had once again said that they'll be cutting rates 3 times this year. While they did not say when the rate cut will happen, the market is now giving a 65% chance that the first rate cut will happen in June 2024, and rates will go down to the 4.5 to 4.75% range by Christmas time. Ho ho ho. And according to the dot plot, we will not see a 2% rate by next year or the year after next, but we'll only see it in the longer run. Then you'll be like, inflation is already coming downwards. Why don't want to lower rates now and send the stock market to the moon? That's because, as we have seen in the past, inflation doesn't just come down in a straight line, but rather it comes in waves. Inflation tends to be a self-fulfilling prophecy. For example, if we think that inflation will be higher for longer, we will tend to spend less and save more, and they will cause inflation to go down. But if we think inflation will start coming down soon, we'll be like, start spending more money and that could cause inflation to go up again, and we'll be like, shit, here we go again. That's why even though during the meeting, the Fed had projected that the PCE inflation will indeed be coming down from 2.4% to 2% in 2026, they still be like, I'm not ready to start cutting rates leh, as they don't want to ease up too quickly and accidentally cause inflation to go back up again. So then, can the market continue to go up? Of course, over the long term, we can all agree that the market is very likely to continue going up, assuming some idiot doesn't go and start World War III, of course. But I'm talking about the short term here, or more specifically, can the market continue to go up in 2024? So far, the market has been on a fantastic bull run since the start of 2022. This was due to a number of reasons, such as inflation has been coming down, the job market has been incredibly resilient, the US economy, which has not only managed to avoid a recession, but has defied all odds and continued to grow steadily from PP. And more importantly, company earnings have been growing strong. Though, if you look at the S&P 500 breakdown, most of the returns actually came from the Magnificent 7 stocks, which are Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and maybe not Tesla, which accounts for almost 1/3 of the S&P 500. Since the end of 2022, these 7 stocks alone have given an average of 154% as compared to the remaining 493 stocks' median return of just 13%. This was all thanks to the AI boom, where 67 stocks in the S&P 500 that have something to do with AI have surged by an average of 45% since the end of 2022, especially Nvidia, which have gone parabolic over the past few months, making the CEO look like the Taylor Swift of the stock market. But then, are we in an AI bubble yet? After all, this is starting to look eerily similar to the dot-com bubble, where back then, the internet was the next big thing. One famous example was Cisco. Back then, they were selling a ton of networking equipment to companies who were looking to enter the cyberspace. Demand was practically unlimited, and Cisco delivered 100% annual returns in the 10 years after its 1990 IPO. By 2000, they had officially become the world's most valuable company. But we all know what happened next. The dot-com bubble popped, Cisco stock crashed by more than 80% and has never recovered since. So, will this happen to Nvidia and the rest of the stock market now? According to the experts, many do not believe that we are anywhere near the peak of the dot-com bubble yet. That's because 1. The current forward PE ratio of the Nasdaq 100 is nowhere as big as during the dot-com bubble. 2. Back then, there was a frenzy of tech companies going IPO, while only 14% of them were ever profitable. Compared to now, there are a lot fewer companies going IPO, and many of these AI-related companies are well established and are making real money, such as Nvidia, Meta, Google, Microsoft, and so on. If anything, we are still in an AI baby bubble for now. Quick pause. Did you know that besides letting you trade stocks, Tiger Brokers also has some pretty useful tools to let you do research? To find that, you can just open up your favorite stock, then at the top, you can tap on the tiny down arrow. You will see some useful info of the stock, such as the price to earnings ratio, price to book, price to sales, the 52-week high and 52-week low, and the current dividend yield. Then, if you head over to the Financials tab, you will find a lot more info about the stock. For example, you will get a quick info of the latest earnings, some estimates of EPS, revenue and EBIT for the next few years. Tiger Brokers also shows you some quick summaries of the company's financial statements, such as income statement, balance sheet, and cash flow. They even show you a breakdown of how the company earns its money and where are the revenues coming from, all of which are definitely useful when doing stock research. Besides that, Tiger Brokers has also just launched their very own Tiger Boss debit card in partnership with Wise platform. You can apply for this card for free via the Tiger Trade app, and with it, you will get to enjoy competitive FS rates for international spending, as well as receive 1% of your eligible spends in Tesla fractional shares from now till 30th April 2024. Right now, Tiger Brokers is also running a welcome promotion. If you sign up using my link down below, find your account with $1,500, hold it for 7 days while completing 5 buy trades, you will earn $40 worth of Apple fractional shares, 1 free stock worth up to $888, and an exclusive $30 worth of Tesla fractional shares. You will also get 0 commission trades for US stocks for 180 days and other markets for 365 days. Though, take note that other fees will still apply. So if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. So where do we go from here? Based on historical data, everything seems to be pointing that the stock market could continue to go up a lot more. Basically, stonks. First, it has been found that whenever the market enters a new bull cycle, there's a 93% chance that the next year will also be a positive year. This is because as prices get higher, it will attract more buyers, which leads to higher prices, which attracts even more buyers. And the cycle will continue to repeat itself until something breaks, of course. Since 1957, we have been through 10 bull markets. And it has been found that after 24 months of being in a bull market, the S&P 500 has gone up by 61% on average. So far, we are only up by 45% from the bottom of 2022. So if history was to repeat itself, we probably still have more room to go. 2. This is an important year, not just because it's a long year. Get it? Long? Never mind. This year is an important year for the US because it's the election year. Historically, the S&P 500 has been positive 19 out of the 23 years during election years, with it going up by an average of 11%. To add on, Fundstrat also found that when there was more than 10% gain in the previous year, the market tends to give even higher returns during election years. 3. Despite all the crazy bull run, right now there's still a lot of money sitting on the sidelines, where there's currently over $6 trillion parked in money market funds, earning an average of 5.2% yield. So guess what will happen when the Fed eventually cut rates in June? Yup, investors will start to realize that the returns that they are getting from money market funds are no longer attractive, and will start to look for better returns elsewhere. And where will it be? Is it the stock market, which might have been going up and is causing a FOMO? Maybe. Then you'll be like, so you mean stonks? Of course not. While the S&P 500 has almost been on just a straight line going up since last year, this doesn't mean that it will continue going up at a 45 degrees angle. One thing you have to be aware of is that the market is now getting rather overvalued. For example, one of the most reliable indicators for checking this is the Buffett indicator, which shows that we have now gone past the overvalued stage and is now nearing the strongly overvalued stage. Based on history, the market tends to drop back down whenever we are in this range. Or how about the price to earnings model? It is also now showing that the market is in the overvalued stage. S&P 500 mean reversion model, overvalued too. Yield curve inversion model, very high chance that we could see a recession within the next few years. However, just because the market is overvalued now doesn't mean that it will just boom and crash tomorrow. In fact, it has been found that in a normal year, it is very common to see market pullbacks. For example, on average, we will see a 3% dip 7 times in a year, or 5% mild correction 3 times in a year. It also means that the higher the current PE, the lower your future expected returns, whether it is 1 year, 5 years or 10 years. Which makes sense, right? When you are buying at a higher price, the return that you will get will be lower. So then, where is the risk? Like everything sounds too good to be true leh. Market going up, low risk of crashing this year, like very sway leh. Actually, the biggest risk is you. Yes, you. As a writer puts it, the biggest risk for most investors has nothing to do with the economy or markets at all. Instead, the biggest risk comes from you. It has been found that from 2001 to 2020, where the market has been delivering some fantastic returns, the average investor only managed to earn an annualized return of 2.9%, which is like very little, huh? This happens when investors tend to buy aggressively as the market peaks and sell aggressively when the market is near its bottom. From 2003 to 2022, if you had just missed the 10 best days of the market, your returns would drop by more than half. Take note, it's just 10 years out of a 20-year period. That's how crazy this is. Miss the 20 best days, your returns would drop by more than 70%. And if you miss 40 best days, you might as well don't invest already, because your returns will now be negative. And the interesting thing is that most of the best days usually take place after a big crash, such as in the 2008 crash and the 2020 crash. You don't need the market crash to get lower returns when you are actively sabotaging yourself. So then, how should you invest your money then? Short answer, DCA. Long answer, DCA. Don't try to time the market by predicting where it's going to go. Don't FOMO into some stock just because it's going parabolic. And don't panic sell just because your stock has crashed by more than 50%, like Tesla. If you have done your research well, and you know it is a good stock, just consistently buy into the stock every month. That's because the longer you stay invested for, the lower the chance you'll be getting a negative return. So here's a pro tip. One easy way to invest consistently is to just set up automatic investments, where the broker will just automatically buy into your stocks every month. That way, you'll be investing consistently no matter what. Market up, you buy. Market down, you cry a bit, then you buy more. And over the long term, you will do well. Anyway, that's all for this video. Hopefully, you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.